and the views of Ridham Desai in the medium term. Ridham, thanks so much for joining in today. Now, since we are on the topic of that, you can slice and dice data anyway and bring out the numbers to look the way you want. But let's assume these are actual numbers, even if they are revised. And within that, there are a couple of concerns that have come out. That is, the gross fixed capital formation hasn't been as great, which probably indicates that the investment cycle is a bit of a lag. A couple of other concerns as well. What did you make of this numbers that have come out, and what are your expectations for the year ahead?
Yeah. Thank you, Neeraj. I'm glad to be on ET. There's an echo coming on my...
Okay.
Yeah.
We'll just try and correct that as well. Meanwhile, so Aisha, I think, you guys had some details about the GDP numbers,
yeah.
but I think that's the criteria with Ridham Desai to ask.
Okay,
it's okay now? Okay, yeah. Great. Ridham, so...
Sorry about that.
No, completely fine. We're sorry about that. But anyways, you were making that point.
Yeah. I think, so we think that the growth cycle has bottomed. Okay, and I think the growth cycle is turning around, and that's evident in a lot of numbers. So, the GDP number is just another piece of data that confirms what's been happening over the past 3-4 months in India. So we've had steel production go up, cement go up, two-wheelers, four-wheelers, and in a lot of cases, even the end consumer demand has gone up for these things. We have our own proprietary work, in which we track 200 cities across India for actual data. And we compile this every 6 months, and that's showing a discernible recovery in job growth. So jobs are back, and I sense, and because we don't do it by sectors, so I'm only guessing here, that it's led by services. We're also seeing a lot of build-up in consumption infrastructure. So companies are investing in malls, they're investing in outlets, they're investing in multiplexes, all the things that consumers touch to consume. And that's a precursor to consumer demand also recovering, and that's, I think, also something that the GDP data tends to suggest.
Yes.
Then you have the evidence from the earnings season, which shows that there has been a turn in revenue growth. In fact, this is the best revenue growth in 8 quarters. So by far the best revenue growth since the new government came in.
Right.
So I think all this is pretty consistent, and not every data matches all the time, and there are leads and lags. But my own view is that I think we are at the turn of an new economic cycle. It's taken a little while because I think the government was busy consolidating the fisc, and that was dragging down growth. We also had a very poor global environment to deal with, and as we know, global trade collapsed last year. The global environment remains, I think, challenging, but domestic consumption seems to have turned. So I think the outlook is for a bit of acceleration in growth.
So is that enough to take the markets higher from where we are right now? Or do you think for the near term, global factors could weigh in?
So see, Neeraj, the markets anticipate this. Right?
Yes.
And the markets have done a bit of a yo-yo. But net, they've done nothing over the past, say, year.
Yes.
In fact, they're down. And in relative terms, India has actually done better than emerging markets. It's outperformed by about 12 points over the past 1 year. I think the relative outperformance sustains. If that question is on where does the absolute level of the index go, I think that still hinges largely in the short run, at least, on global factors. Over the medium term, I think India, it has been decoupling and will continue to decouple.
Right.
So if you take a 2 to 3 year view, I think the index should deliver pretty good returns. But if you take a 3 to 4 month view or a 6 month view, or say let's discuss second half of 2016, I feel the market is a bit heavy.
You think so because
the global markets are heavy.
Okay.
So we have a less than sanguine view on equities. In fact, our global equity strategists are not constructive on equity markets almost anywhere in the world.
Okay.
So we think the US markets are heavy. We think European equities are done. We think Japanese equities should be going down. And in that backdrop, India is the 8th largest market in the world. It's hard for India to deliver absolute gains against falling markets. Yet, we think that there could be modest absolute gains, but not a lot. And that's largely to do with global factors.
So I would take that you believe that if there is a dip, and a substantial one due to global-led factors, it will be an opportunity to buy. And if that is indeed the thesis, I was just looking at your comments as well about how this earnings season has been and how ex-banks, the earnings growth has been very impressive. Where do you place your bets in terms of Indian equities?
Yeah, so the dips will give medium and long-term investors opportunities to buy. So, if you are a long-term investor, you really don't want to worry about timing.
Yes.
Yet I think at this stage you want to keep a little bit of cash on the side. You want to keep some gunpowder in your ammunition, because I think you will get a slightly better entry opportunity if you want to really get cheeky about this. Again, forecasting equity markets is not something that I do very well.
Nobody
for
does.
Short run.
That's okay.
Okay, but I think there could be better opportunities, and a dip certainly I think should be bought aggressively. I mean, that's what sometimes I get the call right, and we got one call right in February, and we were hammering the table when the markets were plummeting just around the budget that this is overdone and we should buy it. The difficulty is that when markets fall, investors become reticent and everybody becomes bearish, and they forget that the medium to long-term story is good. So if you can do that, then I think it is worthwhile waiting for that fall. If you can't, then you just do systematic investing and not worry about dealing with your own emotions. Now, on the point that you asked about where to go, I think, as I cited, consumption, I think, is the place to go. You want to buy discretionary over staples, because I think staples has been a big beneficiary of the fall in commodity prices. So has had very strong trailing earnings growth, and the valuations look quite rich. So I don't think that's a good combination. On the other hand, I think discretionary is actually right now reporting below trend earnings, and has, I think, reasonable valuations if you look on a forward basis. So that's the place where I'll be, which is things like autos, retail, and even media. But the auto stocks occupy a lot of space in our focus list, and we are currently 500 basis points over the benchmark on consumer discretionary. And that's the biggest that I've had since I've been running this sector model portfolio. So as such, you can say this is the most bullish I've been on discretionary consumption since I started running my model portfolio. So that's, I think, a statement that we'd like to emphasize on. The other place, I think, is retail banks. And we were having a bit of a debate yesterday here at the summit, whether it should be state-owned banks or retail banks. And I'll step back and make another comment here, which is, we wrote a report a month ago.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.